I'm Adam Kiley, the CEO of Frontier Energy. Frontier is an ASX listed company, and we're developing the Waroona Renewable Energy Project, which is located in Western Australia.
Adam, good to see you. We saw you back in July. Life has changed since then. You've been through the ringer. What's going on over there?
Yeah, listen, Matt, there's quite a few steps through it, so we may as well start at the beginning. Listen, obviously, when we last spoke, we were getting very close to debt as well as financing the project overall. Our whole debt strategy previously was dependent on getting a 5-year locked-in capacity market. So taking a step back, in electricity markets overall generally, you either have capacity markets or a free market, where the free market, you sell energy and the market corrects itself and it's got a much higher price, or you have a capacity market. So Western Australia is the only place in Australia where there's a capacity market. The trade-off for that is we have a lower maximum energy price, so it's $738 per megawatt here. On the East Coast, it's $18,000 a megawatt. But to make energy providers whole, you're paid this reserve capacity amount. So when there's an energy deficit in the market, which there was when we commenced the debt financing process in February, March of this year, there was a 20% deficit in the market. When there's a deficit of any form in the market, you have the ability to lock in that reserve capacity price for 5 years. As you know, with any debt financing, you generally want a guaranteed revenue stream if you're going to go main banks. That 5-year lock-in price would have allowed us to get that lock-in revenue stream. And the price was forecasted to be $230,000 per megawatt, which was going to work it out at about $23-24 million per annum. So that would have been more than sufficient for the leverage position we were going to. Obviously, when there's a deficit in the market, governments and AMO, they can look to accelerate to help close that gap. There's an acronym, it's called NCAS. So what NCAS basically is when the government can go directly to industry and accelerate the process to get new capacity onto the market quite quickly. This is what the government did in between us selecting the debt financing strategy and then that final reserve capacity allocation in September, which we'll get to. When they did that, they went to market and they paid a long way overs for a number of projects to get up. Importantly, all of these projects that got up, there was no generational projects. They were all standalone battery projects. So the government accelerated, it was about 1.5 gigawatts of standalone battery projects. The largest one overall in terms of payments, they paid Neoen $591,000 per megawatt for a battery they were bringing through, which in essence was going to be paying them $350 million over a 3-year period. So great for them. Unfortunately, by accelerating these standalone batteries on the way through, it meant that the market moved from a capacity deficit into a slight surplus. When the market moves into that slight surplus of greater than 3%, anyone that selects in their reserve capacity allocation a 5-year lock-in price is knocked out. We, unfortunately for us, because we'd selected that 5-year based on the information that was publicly available, we'd selected that 5-year because that was the debt financing strategy we had in place. And despite us getting through the initial round of capacity, when they do that final allocation on the final pricing, we were provided no allocation, which meant we were out of the reserve capacity cycle for that year. That obviously then had the knock-on effect. Our debt financing was contingent on getting the 5-year lock-in price. So we'd announced we got $215 million of debt. That we terminated that mandate, obviously. And we also had the second tranche of an equity capital raising. We terminated the second tranche of the capital raising because, to be frank, it would have been the wrong thing to do for investors, given that they were investing in us because of the allocation we're expecting to get through. So in essence, it's been no doubt a tough last 6 months overall because things have unwound from that point of view. But in essence, the fundamentals of the project haven't actually changed. And I'm sure we'll step through now what it is we're doing again. And in essence, our key focus now is getting that financing strategy completely back online for the company. And that's where all of our energy is going into now for the next number of months.
Okay. But what I need to do is feel comfortable that the management team knows what it's doing, right? Because you've been through a process, both you and the debt guys have got to assess risk, okay? And given you knew the extent of, the influence of the state government and, what they potentially could be capable of doing, did none of you foresee this? I mean, this is kind of, is this on you or is this something
Oh,
that's just
listen, at
come
the
out
end
of
of
the
the
blue?
day, management has to wear it. Management and our advisors were the ones that selected this path to go down. But at the same time, we'd received proposals from major Australian and international banks. Everyone in the industry believed that this capacity market was not going to be filled up as quickly as what it did overall. There's another independent report which is put out by AMO every year that came out in June, July, and it's called an ESO report, which is the forecast of where the market is. It was still forecasting at that point in time a deficit for 2 months in advance. So that deficit was still forecasted in place by all the experts in the industry. Unfortunately, however, when it came through to that final number and the final allocation, there was a number of projects that they didn't expect to get through or the government worked through in this NCAS process, which pushed it over into a surplus. So again, management's the one that wears it. Management's the one that, is responsible for this, but the speed at which it actually came through, it was not forecasted by anyone.
Right. Okay. So what have you got to do to fix it?
Yeah, well, I suppose first off, when we go through the reserve capacity allocation next year, we won't be selecting a 5-year option again. So it's essentially now where we're at. We've just recently released an updated definitive feasibility study. Usually people question, well, why coming out with an updated DFS? You only released one in February. I suppose if we look at some of the things that have worked through in our favour has been there is an oversupply of both batteries as well as panels around the world at the moment. Given that oversupply, prices are falling. So when we came out with the original DFS, the total capital cost was $304 million. The updated capital cost now is $282 million. Probably the other key point from that aspect is as well, when we were obviously getting ready to commence production, we had received final contracts from EPC, construction, all the equipment. So we're very firm on those prices. We wanted to get those numbers out to the market. The other aspect regarding that as well is what's happening with your revenue and costs inside overall. So energy prices, again, we had independent experts provide this to us. Energy prices had gone up by 10 to 15% over those last 6 months. Reserve capacity prices, despite being knocked out, they'd still forecasted that they were going to increase again as well. So the economics of the project, they strengthened overall, and it meant that the returns of the project, despite what happened, were forecasted to get stronger into the future. So we believe that before we commence or recommence the financing project, that we provide that updated DFS to give all investors basically the clean slate before we move into that again.
Okay, so can I be clear about what your message is? Clearly, a lot of time and money and effort has been expended in terms of getting the debt and then looking at the equity and having to cool that off, etc. And you will have, and that you'll have also lost time by going through this new process of yours albeit with a new DFS. What's the upside in this? Is there an upside in this going forward?
Yeah, well, listen, I suppose overall it's a key point of what we're doing it slightly differently this time compared to last time. We're having a lot of very direct conversations with a lot of different strategic parties at the moment that are looking to enter the West Australian market. A lot of those parties probably weren't around last time, and it's probably been given that the time that we've had, we've now been able to engage with a lot of those parties very directly. So we do know the valuation of the project is a lot stronger than where it is actually at the market as well. So we've had time to reassess that, and that's probably key. We're going to be relaunching the strategic process as well as the overall financing process for the project overall. I suppose as well the other key benefit, as mentioned, the capital costs of the project overall, they have reduced overall. And I dare say with what we're seeing in the market at the moment for panels as well as batteries, they're likely, before we get to that final FID decision, they're likely to continue to decrease as we move forward again. So again, we're more aware than anyone about what's happened with the share price. And trust me, we're more disappointed than anyone which has happened because we're all major shareholders in the company ourselves. But we believe the fundamentals for what we have with this project, as well as the thematic that we're actually in, are possibly stronger than ever. It's all about now getting that financing solution completely in place, working through that now over the course of the start of this year, and then executing that to make sure that, in essence, we try as best as we can to catch up on time into the future.
Okay, well, let's talk about risk then, and risk management, mitigation, forecasting. The things that can go wrong. You're going to look at that very, very differently now, I suspect, with a new set of eyes. what are the things that you're really kind of honed in on? What are the, I guess, pushback from any of these conversations that you're having with other groups?
Yeah, listen, obviously, as we touched on, the key strategy we were going for last time on debt was the 5-year lock-in reserve capacity price. That didn't work through. What we're making sure this time when we go through on the debt financing strategy is we're having as many options available as possible to make sure that when we hit that second to the middle of this year, we've got all options on the table and the management and the board can then execute the right one. So when I say that is we're speaking to equipment suppliers at the moment regarding equipment finance. Obviously, those guys are under the pump at the moment to get their product out the door. We're seeing some very attractive initial terms from those guys at the minute. Obviously, debt financing as well. We're stretching it a little bit further this time. So we're not just speaking to traditional banks. And traditional banks, they're going to remain in place. They will need a guaranteed revenue stream. So regarding that, we're speaking to guys now about PPAs, so power purchase agreements. We know there's a strong demand in the West Australian market for it because there's not a lot of new energy generation coming through, especially on the renewable side. Despite the state moving towards 82% renewable target by 2030, and we're still only sitting at 37%. So we know we've got a product from that aspect, which is going to be in demand from a PPA point of view. The other aspect that we're looking at as well to make sure we got the optionality is we're looking at other debt markets that are available. So that's looking at European market and credit markets as well, to make sure that we got options regarding that to provide debt financing from that point of view. Now, that debt is likely to be at a slightly higher interest rate than what we would get from traditional banks for renewable energy. But we just want to ensure that come the middle of this year, we're in that fully financed position to take this project forward as quickly as we can.
It's a really bracing start for your new chairman, wasn't it? What's he going to do? What's he going to do for you?
Yeah. So listen, on the chairman, Mark, we actually announced that Mark was planning to come on through on the project. Unfortunately, due to his work commitments on the way through, we couldn't quite finalise on that fixed date with Mark at the same time. So we both decided that we would go our mutually separate ways regarding bringing him on board. On saying that, we have been speaking to a number of other very experienced potential chairmen as well as directors. I would expect the company at some point very early in the new year to be making a number of appointments regarding that, because it is obviously an area that we will be looking to strengthen significantly. Is board experience, more specifically, board experience with energy in Western Australia at the same time as well.
Right. Okay. In which case, politically, I'm trying to understand the influence of the Western Australia government on projects like yours. Surely they should be encouraging and helpful here. And, as an outsider sort of looking into Oz, it seems very mixed messages, federally, and each state has its own peculiarities too. What is the Western Australian government going to do for you?
Yeah, well, listen, the West Australian government at the moment, they're the same as the rest of Australia at the minute. They're working through a number of aspects. They've obviously got their decarbonisation targets. So Western Australia is currently sitting at about 37% renewable energy, 82% target by 2030. At the same time as that, however, probably the thing that from a West Australian government point of view that scares any government is blackouts. So it's making sure that energy is going to be readily available. Given all that, and we're heading back into summer again as well, just last week we had the 5th highest demand on the grid of all time. We're finding the grid is already under constant pressure. So we continue to work, and we work closely with the WA government to see how they can help us on the way through. From a federal government point of view, the federal government's announced a new program called CIS, which is the Capacity Investment Scheme, and that's looking at helping accelerate renewable energy development projects across the country. What that CIS program essentially does, it's like in essence, a PPA with the federal government. So the government will provide a floor price for your project to get up on the way through, which then you can use that as part of a debt financing strategy. The trade-off on that is there will also be a ceiling price at the same time. So if you exceed the ceiling price, there'll be a profit share with the government. So we've done that submission. Again, we'll find out about that in the end of the first quarter of next year.
Right, and how's the balance sheet at the moment?
Yeah, strong. Listen, at the end of November, we were sitting on about $14.5 million in cash. These projects, I suppose, unlike resource projects, they're relatively low in terms of capital intensity. We've done a lot of the heavy lifting on this project already. We've completed the studies. Our key focus now is getting the financing ready to go on in place. Once that financing's done, obviously then we'll look to work through there afterwards as well.
Right, and how long does this take?
Obviously aiming for getting all the financing in place as quickly as possible. Obviously we're working through a number of measures all simultaneously at the same time to make sure we've got that optionality. But we'd obviously plan to have all the financing in place during the first half of next year.
Right, and what's your message to your... Well, like people, a lot of people sold off here. Yeah, I guess you've had mixed levels of support. Message to your current shareholders and any new shareholders coming in would be what? Yeah,
listen, I suppose it's the same as any project. If you're in the wrong thematic, you could have the best project in the world in the wrong thematic. Where we're actually sitting at the moment, we believe we're in probably the strongest thematic across all sectors, which is energy going onto a grid. So energy going onto a grid in Western Australia is about as valuable as you can get at the moment. Those connections still remain extremely rare for renewable energy generation. So we obviously have an extremely strong thematic that we're going into. It's proven by energy prices. So energy prices in this state continue to increase. So peak energy prices are up by 110% in the last 2 years. The average energy price is up by about 70%. This is before the whole energy transition really happens. Like, we've still got a long way before we actually get to that 82% renewable target. It's just before a lot of things like AI and data centers really start to kick in our opinion. So we're demanding more energy every day. If you're demanding more energy every day, in my opinion, it doesn't make a difference if you're coal or gas or uranium. You want energy going onto that grid because it's becoming so valuable. And that's in essence why we're seeing our project is at the moment. We're in the best thematic. What we also see with our project is renewable energy projects are all about location. We're located already on the best part of the grid in Western Australia with those connections already in place. We can do huge expansion with this project in the future. What is key and essential for the company now is to get the financing strategy completely right. We're working through that financing strategy, and we're going to be working through to make sure that we've got the best options available, multiple options available, to ensure that we don't run the same course as what happened the first time. So that's probably the key message to shareholders that we've heard as much as anyone. We're all major shareholders in the company. We want to make sure that the financing strategy we put in place is as strong and as least dilutive for shareholders as we make.
Okay. Well, Adam, I appreciate you coming on and actually answering some of these questions. It must have been, obviously, it's a bit of a shock to everyone in terms of how quickly things kind of unravel, but you sound optimistic for the future. Yeah, listen, obviously there's a lot of aspects and moving parts behind the scenes at the moment with what we're working through. We're very, very, very optimistic with what we've got. We've been speaking to a lot of major parties about this project, and obviously it's not just about stage one. Stage one is great. What a lot of bigger players are looking for is how big can this project get, and that's really what we believe the attraction will be for a lot of people. We're all still firm believers in this project, and we're looking to bring it through as quickly as we possibly can.